Hello everyone, this is Stuart Finlay. I'm a volunteer with Good Return and I'm based in Sydney. Welcome to the first module of the Financial Re-Education and Awareness Program, commonly known as the FRAP. The FRAP is going to be about a 3 or 4 module program, and today we'll talk about some of the basics of financial management and project management. And in the next 2 or 3 modules, we'll really get down to the nitty-gritty of how to use the systems that we use in the financial management of Good Return more effectively. And finally, in the last session, we'll wrap it up with a real connection between what we've learned and how you can make an impact on the financial success of Good Return through your role. So today we'll just talk about some of the basics and also just touch on the systems that we use so that we set things up well for the next 2 or 3 modules. Now, a lot of you are very, very good project managers with a lot of experience in project management. And when you think about the bigger picture of project management, if I asked you to consider how you would set up a project from the first place and think about the inputs or resources you might need to do that, and also the 3 or 4 measures of success that you would actually use in managing that project, I wonder what you'd come up with. And we ran this activity in a live session of the module I'm presenting now. And when you take a look at the inputs and resources that you probably always use in the projects that you run, there's a whole list of things that a project needs, and you can turn that into a word cloud such as the one displayed on the left there. And then you're probably managing projects pretty much through a standard process like this. You would initiate the project by setting the scope. You'd probably set some planning, do some plans. Then you'd actually execute the project, and throughout that process, you'd be monitoring and controlling the project and using various criteria. And finally, in the closing exercise, you'd probably do a post-implementation review. And the standard sort of statements about whether a project has been successful or not, and the criteria are that if you've set up the goals and objectives of the project in the first place in the scoping, and you've actually achieved those objectives, you've done it on time, you've done it within the budget that you set, and you've done it to a sufficient quality, you've definitely run a very successful project. So thinking about the financial aspects, why is it important to develop and improve financial management skills? Well, throughout my career and even now in my paid work, I run a business acumen program for both government departments and normal corporate enterprises. And what I find is that people may understand their own role and their function in an organisation, but they actually don't necessarily understand the impact they can make on the financial success of that organisation. And it's often because they don't understand why they make that impact or how they make that impact. And also, in the terms of the context of the strategy of the organisation, how does it all fit in and fit together? Well, I always think about it across 3 groups of people as to why financial management skills are so important. And in our context, one is the participants in the programs and the projects that you run are obviously going to benefit from dealing with people in Good Return that are very, very astute in terms of financial management. Secondly, for your own career, it's highly beneficial to be able to understand the profit, the loss, the revenue, the expenses, the assets, the liabilities of Good Return, and how your role impacts those. And by enhancing your own skills, you'll be able to do a better job. You'll probably get more job satisfaction. Plus, you'll have a bigger voice. You'll have a stronger voice at the table when financial management issues are discussed. And then finally, it's fairly obvious that the people who help fund our organisation are very, very interested in seeing the money used more effectively and ensuring that we make a strong impact and meet our mission. So I always say that it's great to know something, but to use that knowledge intelligently, it's probably more about equipping you with enough knowledge so that you can ask the right sort of questions. Because a curious mind, particularly in regards to financial management issues, is also a strong and effective mind. So if we do go back to the bigger picture of good return and think about how we all impact the mission and the vision of the organisation, you think about that vision of a world without poverty and our mission about empowering people who are excluded from the financial system and basically helping them be more financially independent is what we're all about. So there's that implied role that finance plays in everything we do. And what you may not know is that Good Return is also a company. Therefore, it has a board of directors, it has formal policies, and this creates a range of obligations and reporting responsibilities, particularly financial ones, that imposes a lot of work on the management team and particularly Shane and the board. So I did a snapshot out of our 2024 annual report of what the bigger picture of the finances are in Good Return. And if you look at those three numbers there, the revenue, the expenses, and what's called equity, and I'll come back to that later. From the income side, the revenue side, we generated 3.84 million in that year. And on the expense side, we spent 3.81 million. So naturally, we're not like a normal corporate enterprise that I worked in my career, because we're a not-for-profit. Therefore, if we can make a small surplus each year, that will ensure that we can carry on as a going concern and continue to meet the mission and the vision that we've set out to achieve. But in terms of finance, if we go back to basic, it's probably going to help ensure that no one can pull the wool over your eyes in terms of the terminology used in finance and what it actually means in practice. Now, when I teach business principles and financial management principles, I find this model, which is the 5 business driver model, really handy to help simplify the understanding of any business. Because it doesn't matter whether you're the CEO of Microsoft or you're running a small, say street vendor business in a small village in Southeast Asia. Each of the owners of those two businesses will look at their organisation through the lens of these 5 drivers to ensure it's successful. And the 5 drivers that are critical to the success of any business are cash, profit, assets, growth, and people. And when we're thinking about people in this context, we're thinking about the people we serve and the employees and volunteers that we have in the organisation. Now you'll see those 3 financial statements are also listed against 3 of the financial drivers there, the business drivers. So you may be familiar with these, particularly the profit and loss report is critical for measuring, as you'd expect, profit or loss. The cash flows of the organisation and the cash position shows up in what's called the statement of cash flows. And the assets and the liabilities are shown in the balance sheet, which is basically a snapshot in time of the financial position of any organisation. Now, I like to look at any organisation through this sort of house model. And at the top of the house, the board and the management team set the vision, the strategies, and to a certain extent, the values of the organisation. And if you think back to that 5 driver model, I think in the context of understanding good return, there are 3 of those or 4 of those drivers that are really important: profit, cash, assets, and people. Now, from a profit perspective, because we are a not-for-profit, we only aim to make a very, very small surplus each year. And the goal there is to make a surplus that is approximately 1 to 2% of the expense base. In other words, 1 to 2% of the money we spend. So from a cash perspective, and cash is critical, I'll talk about cash in a minute. Our goal is to remain solvent at all times. I'll explain solvent in a minute too. And to remain cash flow positive in all the projects that we run. We'll think about that as well. And then assets being the productive capacity of any organisation. And any organisation probably has this goal as well, is to utilise those assets and resources really efficiently and effectively to maximise the impact that we have in the field. And finally, from a people perspective, I've sort of looked at it from the internal perspective as to what we try and produce for our employees and our volunteers, and that, of course, is a friendly and supportive workplace. Now, if you like, that is the internal picture, bigger picture of good return. And from if you put yourself in the shoes of Shane and the board, there's some of the parameters that they look at constantly about how is the organisation performing, particularly from a financial perspective. But of course, as we know, we've got all these other forces acting on the company and the organisation from the outside world, the external environment. And a few examples are the organisations that regulate us, for example. For example, ASIC is the regulator that is responsible for supervising companies in Australia. There's another organisation called AUSTRAC, which monitors the inflow and outflow of cash in and out of Australia. The legislation, we're a very heavily legislated country, so the Corporations Act is the one that we have to comply with, particularly because we are a holder of an Australian Financial Services Licence. And as you know, the Department of Foreign Affairs and Trade is also one of our funders, and therefore we have to comply with their regulations. There's other government policies that affect us. There's large-scale economic trends, public opinion, the Australian Tax Office as well we have to report to. There is something called the Anti-Money Laundering and Counter-Terrorism Financing legislation, which you're probably familiar with. And we are also a member of various other organisations relevant to our status as a charity in Australia. So if you go back a step and look at the financial basics of any organisation, there's a cycle that, say, a company, a for-profit company, would follow in terms of its beginnings and then its ongoing operations. So any company starts with usually a contribution of what's called equity from the shareholders, the original people who set up the company. So they will throw some money in, and that is called their equity in the company. In other words, their ownership stake. That, of course, is cash that they put in initially. And if they have sufficient credibility with banks and other financial institutions, they might be able to borrow money from banks and other financial institutions. Of course, that's called debt. So really, the cash that is initially created in a company only comes from two sources. There's only two possible sources, equity or debt. Now, to create a productive base for the company, some assets will be purchased, and some of them are longer term assets called fixed assets, and the shorter term assets that we use up within 12 months are called current assets. Now, once we get going, we'll produce sales and expenses, or revenue and expenses, naturally. And if you take the expenses off the revenue figure or the sales figure, that will create something called the net profit before tax. Now, we don't necessarily pay tax in good return, but most companies will. And a company that is not like ours, but a for-profit company, will often pay dividends to the shareholders as a way of rewarding them for putting money into the company in the first place. Now, out of that net profit, once you've deducted the tax, you've deducted the dividends, there may be some money left over as what's called retained profit. So the retained profit will then will add to the cash balance, which then we use in a company to generate further growth and continue the financial cycle. Now, as I said, in Good Return, we don't pay dividends because the people who originally put money into Good Return to create it, which is a company limited by guarantee, are people called members. And the members may have thrown in a very small amount of money initially to get the organisation going. But in a company such as ours, dividends are not paid, so I've taken those out. And likewise, because we are a charitable organisation, we tend not to borrow money, and I don't think actually allowed to borrow money from banks. So let's go back to a couple of the most important aspects in that 5-driver model that I talked about. Now, cash is interesting because it's often overlooked by people who are not close to the action in terms of managing the finances of a company. But cash is absolutely critical. It's the fuel of any business. And so when you define it in basic terms, it's the physical money we have on hand or the very, very short-term bank deposits we have available to us. So that would be the bank accounts we operate on a regular day-to-day basis. Then we have these other terms that often pop up in the language of finance. The cash position, for example, often gets called funds available. It's exactly the same thing, and it simply reflects the amount of money that a company has on hand and is available, effectively immediately. Probably the most important term under the cash driver is operating cash flow, and that is essentially the money the money that is brought in versus the money that's actually sent out from the organisation on a, say, weekly, monthly, quarterly, annual basis. So it is effectively the amount of money we receive in from donors, grantors, lenders, etc., less the money we use in the normal operations of the business. Now, there's two other terms there, and the strict textbook definition of liquidity, for example, is the ability of any organisation to meet its short-term obligations. Now, when we talk about obligations, we're really talking about the debts the amount of money that we owe to people on a short-term basis. So that could be the employees, could be our suppliers, it could be some other short-term debts that we create. So if we compare the short-term cash and other short-term assets we have available that can be turned into cash quickly, that is effectively a measure of our liquidity. And then on a longer-term basis, the solvency is the ability to maintain our cash balances above our expenses on a longer-term basis. So if you like, cash flow, just coming back to cash flow, is probably the most important concept to think about from your role's perspective. And you can relate it to your own personal situation. So the money coming in, for example, is probably coming, in your case, coming from the role you have here at Good Return. And if you're lucky, you might have an investment property, so you might be getting rental income. And if you own some shares, you might be earning some dividends from those shares. So that would be the money coming into your cash flow. And of course, the amount of money going out is probably generated by the bills and the expenses, and maybe some personal savings that you're also putting aside. So it's as simple as that. Your personal cash flow is not that different to the operating cash flow of a business. Now, if I asked you this question, and we actually did this exercise in the live version of this module, why is cash flow management and forecasting of cash flow so important? Well, when you think about it, you can probably, if you did this exercise and had a discussion with your colleagues, you could think about things you could do in your role to help improve cash flow management and good return. And then if you think about question 2 there, if you were running the finance area at good return and there was some spare cash available, what would you do with it? Have a think about that. And then the third question is probably the most important one, is what happens if we fail to accurately forecast our large payments into the future? So we did that exercise, and here are some of the answers that came out from your colleagues. Well, to improve cash flow management, good return, some of the things within your control is to, if you own a budget, is to really think carefully about framing that budget in an accurate manner in the first place, as accurately as possible. Then, of course, to spend wisely, not frivolously. And if you have a responsibility for invoicing our donors or our grantors, to make sure you do that quickly, and then to collect the money quickly as well. Because the faster you collect money, the more cash there is available for the organisation to use. And then, of course, if you're also responsible for forecasting budgets and adjusting the amount of money you expect to be spending on your projects, doing that accurately is really important and within your control, and doing it on time is also really critical. Now, obviously, if you did have spare cash available, you could probably invest it. You might put it into a term deposit, for example, with a bank, which will earn some interest. We don't invest in anything other than very conservative cash-like deposits. So investing in things like shares and property is not on the table for us as good return. Now, in terms of the third question, if we fail to accurately forecast, the worst case is we could potentially run out of cash. And really the best case is, we might have to delay our payments to our suppliers or our partners, or we may have to break a term deposit or another, longer term style cash investment to actually make sure that we've got sufficient cash to pay the short-term bills and expenses. So the implications of that, of course, are that we lose interest revenue on those cash deposits. So in summary, strong cash flow of any organisation that is forecast really accurately has these benefits. It actually gives you more options for growth. If you're in a strong cash position with strong cash flow, you can make much bigger impact and you can grow faster, and you may be able to invest those spare funds, as I just said. Probably the most important thing is if you know what your cash position is up front, you're in a much stronger position of having that information to make better decisions quicker. And if you are able to pay your creditors on time, your suppliers on time, you'll have a much stronger reputation with those partners and also with the banks that we deal with. So being prompt with your payments generates a really good reputation. And of course, as I've said before, we have certain obligations to report things on time. So, for example, one of the regulators and one of the organisations we report to requires us to report our solvency position, and I'll talk about that particular report in a minute. Now, one of the things I have noticed through my career is that working in large organisations, a lot of people thought that there was this mysterious unlimited supply of cash that was always available to dip into. And unfortunately, that's not the case, because like any resource, cash is limited and it's scarce. So therefore, we have to ration cash in a sensible manner. So it comes back to the points I've made above in terms of being well informed and making much better decisions. And then what we don't want to do is get into this position where we're fighting for survival, because in many, many situations, you've seen businesses and even governments run out of cash and they now cease to exist. We don't want to get into that position. So there's two main reports that Tim, our financial controller, produces as a result of the cash flow forecasting that you do for us on a monthly or quarterly basis. And the report shown here is a little bit hard to read, I realise, but it's just showing the forecast of money coming in and money going out on a monthly basis through to next June. And so Tim is able to use this report to then determine the green line as to what the balance of our cash might be as a result of those ins and outs of cash flow. This then helps him do what's called the solvency report. And really what that is showing is the number of months we have available to cover the expenses that we expect to have to pay over the next 12 months. And that solvency ratio of available cash in an unrestricted manner over the expenses we are facing is a very, very important ratio that the regulators look at. Now, let's de-jargonise and clarify some of the terms that are used in relation to profit. And profit is not a dirty word because while we're a not-for-profit, which suggests that we'll make a profit of zero each year, you still need to understand what the components of profit are to be able to achieve that zero profit or a very small surplus each year. So you probably know that revenue less the expenses over a given period, the total revenue less the total expenses, represents the net profit of any organisation. So the revenue sometimes gets called different things, and I've probably already used these terms today. Some people call it income. Retailers, like shops and department stores, often call it turnover. The medical profession and the the professions tend to call their revenue billings. And then in casual terms, it's often called the top line because it's usually the first line of a profit and loss report. All those things mean the same thing. Operating expenses are then the expenses of the organisation on a day-to-day basis. That often gets shortened to the term OPEX. Some people call it overheads, and other people call it general administration expenses. All of those terms are exactly the same thing to describe the expenses of an organisation. And then even net profit or profit as a term gets called different things. So some people will call it net income or comprehensive income or net earnings. And I bet we've all used the term the bottom line simply because the bottom line is the same thing as net profit, and it happens to be the last line on the profit and loss report. The other term that's sometimes used for profit in relation to individual projects or products or services is the term margin. And margin is the same thing as profit, so it's revenue less the expenses, but it's often expressed as a percentage of the revenue that generated that profit. So the example I'm giving you there is, say you bought an apple from a supplier for $1 and you had a fruit stall and you sold that apple for $1.50. So the profit you've made is obviously 50 cents, or a margin you've made is 50 cents. So you take the margin of 50 cents, divide it by the revenue that you earn, or the price you set for the apple, and that simple mathematical equation gives you the margin of 33%. So margins are a good indication of how an individual product, service, or project is performing. Now, you've probably heard the term prepayment, and that's often in relation to expenses. So it's cash flow out in advance for a product or service that the business is going to use into the future. So in other words, if you do the prepayment this month, but the service or the product that you've bought will actually have benefit to the business for longer than that month, say 12 months, that's a prepayment of that expense 12 months in advance. And I'll give you a demonstration of that in a minute. The flip side of a prepayment, the opposite of a prepayment, is something called an accrual. So let's say that we use a service in the business that we haven't actually paid for yet. We have to recognize the expense related to that service in the profit and loss statement, even though we haven't actually paid for it yet. So we have an insurance policy that is essentially covering us for accidental loss, and it's $120,000 premium, but we don't pay it until later in the year. We still have to recognise 1/12 of that annual premium in each month of the calendar year that we use that service. So that's an accrual. And then the other term that's often used in relation to profit is when you're looking at an individual project or an investment in an asset and looking at the new profit that particular project or investment generates. So let's say you were running a project that was going to cost $100,000 and you generated a new profit from that particular project of $5,000. The return on investment is simply the profit divided by the total cost of the project expressed as a percentage. So in this case, it's $5,000 over $100,000 is 5%. So pretty basic stuff. Where is it all measured? Where's profit measured? Well, it's measured in the profit and loss report, which sometimes also gets called different things, such as the statement of comprehensive income. So in 2024, the good return profit and loss that I've already alluded to is shown on the screen, and I've highlighted the big picture numbers. So I've already talked about those numbers. So revenue in that year was 3.8 million, and the expenses were about the same. So the surplus was very small. But as a not-for-profit, that's our goal. We covered our expenses with enough revenue to make a very small surplus. Now, I'll just give an example of why profit does not always equal cash flow, because people get very mixed up with, they think that if you bring a certain amount of money in and you pay a certain money out in a period, that must be the profit. But profit is calculated on an accounting principle called the matching principle. And I've already sort of given this example away by talking about insurance. So say we, once again, we had an insurance policy that had a premium, i.e. the price of that insurance policy is $120,000 for a whole year. And what we decide to do is we decide to pay half of that amount in January of 2024. So effectively we've paid for 6 months of the 12 months coverage of that policy. So what that means is the cash flow is $60,000, i.e. half of the $120,000 in that January when the payment is actually made. But the recording of the expense in the profit and loss more accurately reflects the benefit we get from that payment each month. So in other words, the $60,000 payment has to be spread over the 6 months that we get benefit from the premium. Therefore, 60,000 divided by 6 is 10,000. So the way it shows up in our financial reports is that the cash flow is $60,000. I'll just highlight that for you down here. Whereas the expenses are recorded in the profit and loss statement as $10,000 each month. So that's that $10,000 per month. I hope that's clear to you all. So the accounting profit is calculated on the basis of this matching principle. That is, it actually applies to both revenue and expenses. But in this case, expenses is the easier example to use. So they're allocated to the month where they're either earned or used by the business. quick word on assets, and there's a different definition from the accounting perspective, but I like to look at an asset as anything you own or you can control that adds to the productive capacity of the business. And there's two broad types of assets in any organisation. Assets that you can touch and feel, like a photocopier, or intangible assets, which is something you can't touch and feel but still has value. And the example I've used there is effectively our branding. Good Return as a brand actually delivers value because it's recognised out there in the public. So assets are important to manage in the business because they're a bit like any asset that you own as well. If you maintain them well and keep them operating at maximum efficiency, you're more likely to get greater use out of that asset over the long term, so that you don't have to replace it every 2 or 3 years. So finally, thinking about how we manage the finances of Good Return, you'd be familiar with these 4 systems. And we're going to dive, the next 2 or 3 modules, we're going to dive a lot deeper into these systems so that you're more familiar with how to actually use them effectively to create that bigger picture effect of driving revenue, managing expenses well, and ensuring, most importantly, that our cash flow is strong and forecasted accurately on a prompt basis. So you know about Dext. It's the platform that we use to manage the invoicing in terms of our expenses. That would be either the credit card expenses or the invoices you receive from our suppliers. Approval Max is effectively the way we ensure that the authority to pay those invoices from our suppliers and manage our expenses is done appropriately. And then QuickBooks is effectively the integrator of all the other systems to create the accounting system, which then generates the reports that we need from a pure profit and loss perspective and a balance sheet perspective. Finally, Calxa is an additional system that helps us manage the cash flow and the budgeting. So Calxa sits out to the side to a certain extent, but it does talk to QuickBooks to ensure that the 2 things are integrated. But as I said, we'll talk about those in more detail in the next 2 modules. So that's about it for the moment. I hope you've enjoyed the module. I'll be back, and coming up next, as I said, is Module 2, how to use the systems effectively. Please reach out to me if you've got any questions, and I'll see you next time.